Hey there, everyone. Welcome to my mortgage market update for the week of May 15th. For all the mothers out there, I hope you enjoyed a nice, relaxing Mother's Day. This past week, mortgage rates held near their best levels of the last several months in response to the lowest inflation reading in 2 years. Let's recap the happenings from the last few days that are setting the stage for the coming week. Inflation is indeed moving lower. As you may remember, we were waiting with great anticipation for last Thursday's CPI print, or the Consumer Price Index, which is a closely watched reading on consumer inflation. Well, it was reported at 4.9% year over year, which was lower than expected and the lowest reading since April of 2021. This time last year, CPI was running hot, above 9%. So seeing annual readings under 5% is indeed a welcome sign. There is also a reason to be optimistic about even lower inflation readings ahead. Shelter, which includes rent, makes up a sizable portion of CPI. That figure, which lags as declines in rent take time to hit the report, are finally appearing in the report. We should expect the shelter component to continue lowering inflation later this year and into 2024. This will help keep long-term rates, like mortgages, all beneath current levels. Now, don't take these odds to Vegas. A 1.5% chance. The softening inflation reading is adding to the idea that the Fed should pause on rate hikes in June. As of right now, the financial markets are pricing in just a 1.5% probability that the Fed will hike rates at their next meeting in June. After the fastest rate hike cycle in 40 years, this would be very welcome news for all. Despite Fed officials stating otherwise, the financial markets are pricing in a high probability of multiple Fed rate cuts later in the second half of this year. If inflation cools further, unemployment starts to rise, this may indeed come to pass. Debt ceiling debacle. Add one more uncertain event to our economy, and it is the debt ceiling debacle taking place in Congress. Essentially, we will reach the limit to what our government could spend as early as next month. This means that Congress has to agree to raise the limit regarding what we could spend, or we risk a potential debt default and credit downgrade like we saw in 2011. Most everyone believes that aside from the political grandstanding and bickering back and forth, a deal will get done to ensure the U.S. doesn't default on its debt. However, in the near term, it could cause increased volatility and a potential uptick in rates, including mortgage rates, as the threat of a downgrade rises. Sell in May, and after a rough 2022, stocks have enjoyed a couple of strong quarters of gains. Now we enter the summer months, and the old adage, sell in May and go away, is gathering steam. Essentially, the idea is to sell stocks in May and re-enter the market later in the year. So why does this matter? If stocks move measurably lower amidst all the uncertainty, fixed income securities like mortgages will likely be the beneficiary, putting downward pressure on rates. Looking ahead, we'll continue to watch for any progress on the debt ceiling debate and uncertainty within the banking sector. The economic calendar will have readings on retail sales, housing, and regional manufacturing data this week. Bottom line, this continues to be an important moment for interest rates. As we go to the chart, you will see that our line in the sand at that 200-day moving average is indeed putting up a tough fight. So let's go ahead and take a peek together. This will be the last quarter of mortgage-backed securities, the 5.5% coupon of the Fannie Mae bond. This is bond pricing. As bond prices go up, rates go down. They have an inverse relationship. Green days are good and red days are bad. The 200-day moving average is this blue line. Again, it remains a formidable line in the sand for us to cross, even though we had a nice push above it after the CPI print last Wednesday, maintained that on Thursday, but we sold off as uncertainty surrounding the economy continues relating to the debt debacle debate. So let's go ahead and continue to watch things as we go forward this week. Hopefully we'll see this gain some footing and return towards that 200-day moving average and push through it. I appreciate your time here today. Thanks for spending it with me. Feel free to share this with family or friends, comment below, or shoot me a text or email with any questions if I can be of help. Appreciate it and enjoy your day. Thanks a lot.